Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of Chicago wheat and corn. I'll start with Chicago wheat. There are two major patterns running this market higher since about July. The first is the March to July shallowly bullish shift pitchfork. Notably the middle tine as a support proxy, currently at 716, and specifically the upper tine, currently 803. Now, this upper tine magnificently capped the market 11 weeks ago. As I've previously said, and I quote, "This is a shallowly bullish pitchfork, but one should not underestimate its power," end of quote. Thus, the top side has been in the past, and in all likelihood is still capped by this upper tine. The second pattern is more recent. It is the July to September bullish shift pitchfork. In this pattern, we are most recently seeing the market channeling higher in between the lower tine, currently at 732, and the middle tine, currently at 802. Notably, the middle tine was tested back in early October and held, but the lower tine has not as yet been tested. More recently, we've seen the market move higher after 2 weeks ago prices dropped down to test the combination of the March 2014 high at 725 and the rising short-medium moving average, currently 737. These held, and the product of this was to spur the market move higher over the recent high in August at 786.5. However, this move up, though bullish, has been tempered by two things. Firstly, the approach to the previously mentioned upper tine of the March to June bullish shift pitchfork and the middle tine of the July to September bullish shift pitchfork. Secondly, and perhaps more importantly, these tines cross over on Monday. That's right, next Monday. Now, I know that these are not directly related tines, as in one is an Andrews pitchfork and the other is a shift pitchfork, both at the same time period. However, they are to me indirectly related tines, and the crossover period should be viewed in caution. In related crossovers of tines, you can usually see one or more of the following happen: a change of trend, a reinforcement of trend, or a period of general volatility. I'm not certain we may have one or more of these happen around about next Monday, but it is probably prudent to be prepared just in case. Chicago corn. The move down below the long moving average, currently at 563, 8 weeks ago, looked like a seminal moment. First proper break below the long moving average since November 2019. Well, it was a major move, and the market did try and exploit it, dipping lower, but it was only in a limited fashion. In a large part actually, I suspect the failure to really move lower was due to prices hesitating around the key combination of the 61.8% absolute Fibonacci line at 525, which is also the 2014 high. Eventually, prices did construct two main patterns: a sideways triangle and a descending triangle. All this I had previously discussed, but to recap, the sideways triangle was formed on the top side by the 2 points of downtrend, currently at 535, from the start of July, that is, and below by the broken, well broken indeed now, July to September uptrend, which at the time, with at the time its now departing partner, the long moving average. This had a potential target X on the downside in the 509 area, which was achieved 7 weeks ago. Meanwhile, the descending triangle utilized the same June to date downtrend on the top side, now a 3-pointer, but then also had a flat base made up of the previously mentioned key combination, the 61.8% absolute Fibonacci line at 525 and a 2014 high at the same level. This now has an initial target X1 below in the 475 area, with a secondary target X2 in the 425 area, right on the 50% absolute Fibonacci line, which is why you can still see them labeled on the daily chart, though I'm currently contemplating retiring them. So, all well and good. However, the market had some other ideas, and over the past 3 weeks prices have risen over the 61.8% Fibonacci combination over the downtrend and over the medium moving average, currently at 549, until 3 days ago prices created a daily key reversal up, and yesterday closed back up over the important long moving average, the first time for 8 weeks. So what did this all mean? Well, an obvious choice would be to see the drop down at the start of September as a false break lower, and I can see the point of that. However, these markets are like life. They are usually a lot more complicated than that, and I think this may be the case here. You see, the move back up over the mid-September to mid-October period seems to have been a disguised period of indecision, with many indecisive daily reactions and counters to the previous session's moves. Additionally, over all of this, we still have, or had, a seeming reluctance for the market to head down below the 61.8% absolute Fibonacci line and 2014 combination at 525. What the market saw until this week were prices being squished between the declining downtrend and this combination of support at 525. I had repeatedly said here that by the second week of November that gap would cease to exist, and thus we needed to look to see whether this descending triangle would cause a fresh break higher or lower after the recent number of false starts. Now, on top of all this, there is one other option that made itself available. It was to look at the July to date action as a possible descending wedge pattern. Now, there is merit in this, with the lower trend line well below, currently at 479, and this week's move up being a break upwards and away from either the descending triangle or this new descending wedge pattern. This prompted me 3 weeks ago to say, and I've repeated ever since, and I quote, "I'm also quite happy to start targeting the top side as well, but only on a confirmed break higher. Keep an eye on things," end of quote. So, last week, though not fully confirmed on the upside at the time, I gave some ideas of potential targets for the descending triangle pattern. We have an initial target X3 in the 605 area, with a secondary target X4 in the 641 area. I can easily see that target X4 is quite an ask, but target X3 is doable. Now let's look at potential targets for the descending wedge pattern. Well, unsurprisingly, the initial potential target for this pattern ties in with the target X3 at 605. However, the secondary target of this pattern is lower. Target X5 for this pattern is in the 626 area. I think I'll leave it there and watch to see if the current moves turn out to be true or false breaks higher. Thank you for listening. This weekly broadcast gives essential market patterns and consequences. Please be aware of the risk disclaimer posted with this broadcast. Copyright is Tofpik and ADM Investor Services International Limited. And here comes the final bit.